Most people want to get rich in 2026 by following tips, predictions, and shortcuts, but wealth has never been built that way. The real advantage comes from seeing how the economic machine actually works, understanding why markets move before they move, and positioning yourself while others are reacting. If you want to be ahead of the next shift instead of crushed by it, you need to think differently about money, risk, and opportunity starting right now. Wealth in 2026 will not be created by chasing what is popular, viral, or emotionally exciting. It will be created by understanding how economic cycles work and positioning ahead of them. Every economy operates like a machine driven by predictable forces such as productivity growth, credit expansion, interest rates, inflation, and human behavior. These forces rise and fall in repeating patterns over time. People who fail financially usually believe the current moment is unique, while people who succeed recognize that what is happening now has happened before in different forms. Economic cycles are divided into short-term and long-term phases. Short-term cycles are influenced by interest rate changes, business activity, and consumer confidence. Long-term cycles are driven by debt accumulation, monetary policy, and structural shifts in productivity. In 2026, those who understand where we are in both cycles will have a massive advantage because they will not rely on predictions, but on probabilities. Instead of asking what will happen next, they will ask what usually happens at this stage of the cycle. Chasing trends often means arriving late. By the time an asset becomes popular, the majority of the upside has already occurred. Media attention, social hype, and public optimism usually appear near market peaks, not at the beginning of opportunities. In contrast, cycle-based thinking encourages patience. It teaches that the best opportunities often feel uncomfortable, boring, or even frightening when they first appear. This discomfort is not a warning sign, but a signal that the crowd has not yet arrived. Understanding cycles also changes how risk is perceived. Most people define risk as short-term price movement, but true risk is permanent loss of capital. When investors chase trends, they unknowingly increase their exposure to permanent loss because they enter positions with little margin of safety. Cycle-aware investors focus on balance, valuation, and sustainability. They ask whether an asset can survive different economic environments rather than whether it will go up tomorrow. Another key advantage of cycle awareness is emotional control. Markets amplify human psychology. Fear and greed expand and contract just like economies. When people understand that emotional extremes are part of the cycle, they stop reacting impulsively. Instead of panicking during downturns or becoming overconfident during booms, they stay disciplined. This discipline allows them to buy when prices reflect pessimism and reduce exposure when optimism becomes excessive. Cycles also highlight the importance of timing without relying on prediction. Timing does not mean guessing exact tops or bottoms. It means adjusting exposure based on where the economy is heading rather than where it has already been. In 2026, many opportunities will exist not because growth is strong, but because imbalance creates mispricing. Those who understand cycles will recognize these imbalances early and position gradually rather than all at once. Finally, understanding economic cycles shifts the focus from short-term gains to long-term survival and compounding. Wealth is built by staying invested through multiple cycles, not by winning a single year. Each cycle teaches lessons about risk, leverage, patience, and humility. Investors who learn these lessons compound not only money, but judgment. In a world obsessed with speed, cycle-based thinking rewards those who move deliberately, study history, and align their actions with how the economic machine has always functioned. The biggest opportunities rarely appear during periods of comfort and stability. They emerge when uncertainty is high, confidence is low, and the future feels unclear. In 2026, imbalance will create opportunity, just as it has in every previous cycle. When markets, economies, or industries move too far in one direction, they eventually correct. These moments of correction are where long-term wealth is quietly built, while most people are focused on avoiding pain rather than capturing value. Uncertainty creates mispricing because human behavior becomes distorted under stress. Fear causes people to sell assets not because fundamentals have changed, but because emotions demand relief. Institutions reduce exposure to protect short-term performance. Media amplifies worst-case scenarios, reinforcing pessimism. As a result, prices often fall faster and further than reality justifies. Those who can separate perception from reality gain access to assets priced for failure rather than for their true potential. Imbalance can take many forms. It may appear as excessive debt, inflated valuations, suppressed interest rates, or neglected sectors of the economy. When capital flows too aggressively into one area, it leaves other areas starved and undervalued. In 2026, understanding where capital has been over-allocated and under-allocated will be critical. Opportunity is not found where money is crowded, but where it has been abandoned. Periods of uncertainty also reveal structural weaknesses and strengths. Weak businesses fail, inefficient systems break, and unsustainable models are exposed. At the same time, resilient companies, productive assets, and strong balance sheets become more valuable. Investors who study fundamentals during chaos can identify which assets are temporarily mispriced and which are permanently impaired. This distinction separates opportunity from speculation. Most people wait for clarity before acting, but clarity usually arrives after prices have already adjusted. By the time confidence returns, early gains are gone. The ability to act without certainty is a defining trait of successful investors. This does not mean acting recklessly. It means relying on principles rather than emotions. When risk is high but compensated, opportunity exists. When risk feels low and universally accepted, danger is often greatest. Imbalance also creates asymmetric outcomes. The downside becomes limited because expectations are already low, while the upside expands if conditions improve even slightly. These asymmetries are where patient capital thrives. In 2026, many of the best opportunities will not require perfect outcomes, only outcomes that are less bad than expected. Understanding this dynamic allows investors to structure positions where the odds are favorable even in uncertain environments. Finally, opportunity during uncertainty requires psychological resilience. It demands the ability to look wrong before being right, to tolerate discomfort, and to remain detached from short-term results. History shows that wealth is transferred from the reactive to the prepared during periods of imbalance. Those who embrace uncertainty as a feature rather than a flaw of markets position themselves to benefit from the corrections that inevitably follow excess, fear, and overreaction. Diversification is often misunderstood as a strategy that limits returns, but in reality it is a strategy that protects decision-making. Most people believe diversification means lacking conviction, when it actually means acknowledging uncertainty. No one can consistently predict the future with precision, especially in complex systems like markets and economies. In 2026, this understanding will separate those who preserve and grow wealth from those who take risks they do not fully understand. Ignorance is not a lack of intelligence. It is a lack of foresight into how different forces interact. Economic outcomes are shaped by variables such as inflation, interest rates, growth, geopolitics, and policy decisions, many of which are outside any individual's control. Concentrating wealth in a single asset or idea assumes that one outcome will dominate. When that assumption fails, losses can be severe and permanent. Diversification accepts that multiple outcomes are possible and prepares for them simultaneously. True diversification is not about owning many assets that behave the same way. Owning 10 assets that all rise and fall together provides the illusion of safety without real protection. Effective diversification means spreading exposure across assets that respond differently to economic conditions. Some perform well during inflation, others during deflation. Some benefit from growth, others provide stability during contraction. This balance allows a portfolio to survive different environments without relying on perfect timing. In 2026, diversification will be especially important because correlations tend to increase during stress. Assets that seem independent during stable periods can move together when liquidity tightens or fear spreads. A well-diversified approach anticipates this by including assets that protect purchasing power, reduce volatility, and provide optionality. Optionality is the ability to take advantage of opportunities when conditions change, which is only possible when capital is preserved. Another benefit of diversification is emotional stability. Large concentrated bets amplify emotions, leading to overconfidence during gains and panic during losses. Emotional decision-making is one of the biggest destroyers of wealth. Diversification smooths outcomes, making it easier to stick to a plan. When volatility is managed, investors are more likely to remain disciplined and rational, which improves long-term results more than any single winning investment. Diversification also reinforces humility. It is an admission that even well-researched ideas can be wrong. This mindset encourages continuous learning and adaptation rather than attachment to a single narrative. Markets punish certainty and reward flexibility. By diversifying, investors remain open to new information and adjust as conditions evolve instead of defending outdated assumptions. Ultimately, wealth is not built by maximizing returns in one scenario, but by ensuring survival across many scenarios. The goal is not to be the smartest person in the room, but to avoid being the most exposed to being wrong. In a world of increasing complexity and rapid change, diversification becomes less about spreading money and more about managing ignorance, uncertainty, and risk in a disciplined and structured way. Cash, debt, and inflation are often viewed emotionally, but they are not moral forces that reward or punish people. They are mechanical components of the economic system that interact in predictable ways. In 2026, those who understand this mechanism will use these tools strategically, while those who misunderstand them will react emotionally and lose purchasing power without realizing why it is happening. Cash feels safe because it is stable in nominal terms, but its real value is constantly changing. When inflation rises, cash quietly loses purchasing power. This loss is rarely felt immediately, which is why it is often ignored. People focus on visible market volatility while missing the slow erosion caused by rising prices. Holding cash without a purpose is not safety. It is exposure to a different kind of risk that compounds over time. Debt is often portrayed as inherently bad, but debt is simply leverage. When used irresponsibly, it magnifies losses. When used carefully, it can accelerate growth. The key variable is the relationship between the cost of debt and the return on what that debt finances. In an environment where borrowing costs are lower than productive returns, debt can be a powerful tool. When costs rise or cash flows weaken, the same debt becomes a burden. Understanding this relationship allows for informed decisions rather than blanket avoidance. Inflation connects cash and debt in a subtle way. Inflation reduces the real value of money, which benefits borrowers and harms lenders. Those who borrow at fixed rates during inflationary periods repay debt with cheaper money over time. Those who hold cash or lend at fixed rates absorb the loss. In 2026, recognizing who wins and who loses from inflation will be critical to preserving and growing wealth. Monetary policy plays a central role in this system. When central banks increase money supply, they do so to stimulate economic activity or stabilize the system. This newly created money does not spread evenly. It flows first into financial assets, businesses, and sectors closest to the source. Those who understand this flow position themselves where the money goes, not where it eventually leaks. This is not speculation. It is observation of how the system consistently operates. The mistake most people make is treating these tools as static. Cash, debt, and inflation are dynamic forces that must be adjusted as conditions change. There are times when holding more cash makes sense, times when leverage is advantageous, and times when inflation protection is essential. Rigid thinking leads to missed opportunities and unnecessary losses. Flexible, principle-based thinking allows adaptation without panic. Ultimately, wealth preservation and growth depend on understanding how these forces interact over time. Cash provides liquidity, debt provides leverage, and inflation reshapes value. When used consciously, they become tools for strategic positioning rather than sources of fear. Those who master this relationship do not fight the economic machine. They align themselves with its mechanics and let it work in their favor. Wealth that lasts is not built on isolated insights or lucky decisions, but on systems that produce consistent outcomes over time. In 2026, the greatest advantage will not be access to information, because information is everywhere. The real advantage will be having a clear framework for making decisions under uncertainty. Systems turn complexity into structure and reduce reliance on emotion, intuition, and impulse. A system is a set of rules that guide action regardless of external noise. It defines when to act, when to wait, how much to risk, and how to respond when outcomes differ from expectations. Without a system, decisions are made reactively, driven by headlines, opinions, and short-term results. With a system, decisions are made deliberately, based on predefined principles that remain stable even as conditions change. Principles are the foundation of any effective system. They are formed by observing cause and effect relationships and learning from both success and failure. Unlike strategies, which can become outdated, principles adapt because they are rooted in how the world actually works. In investing and wealth building, principles such as balance, risk control, diversification, and long-term compounding remain relevant across cycles and environments. Decision-making frameworks also create accountability. When outcomes are poor, a framework allows for analysis without self-deception. Instead of blaming markets or luck, investors can examine whether the process was followed correctly. This feedback loop accelerates learning and improvement. Over time, small refinements in process produce large differences in results, not through brilliance, but through consistency. Another benefit of systems is scalability. A good decision framework works whether capital is small or large. It prevents overconfidence during success and desperation during setbacks. By standardizing responses to common situations, systems free mental energy for higher-level thinking. This reduces cognitive overload and improves judgment when stakes are high. In 2026, volatility and information overload will challenge attention and discipline. Systems act as filters, blocking out irrelevant data and focusing on what truly matters. They prevent overtrading, reduce stress, and increase the probability of favorable outcomes. People without systems are easily swayed by narratives. People with systems evaluate narratives against objective criteria. Ultimately, repeatable wealth is the result of repeatable behavior. Systems transform good ideas into reliable action. They allow progress to continue even when confidence fades or conditions deteriorate. While individual decisions may succeed or fail, A well-designed framework compounds advantages over time, turning discipline into growth and uncertainty into structured opportunity.